Today, we are looking at a business model that, on the surface, seems incredibly low tech.
Right.
It's all about heavy lifting, it's focused entirely on dirt.
Yeah.
But the potential profitability numbers, they suggest we might be looking at one of the highest margin local service industries out there right now.
It's lawn aeration.
Exactly. We are diving into the economics of lawn aeration.
If you're looking for a low complexity, high cash flow business,
Mm-hmm.
the systems built around, well, sticking metal spikes in the ground are surprisingly robust.
Absolutely. And for those of you who might only see this happening, once a year on the local golf course,
Oh,
here's the basic idea. It's the process of mechanically pulling these small plugs of soil out of the ground. It sounds like you're damaging the lawn, but it's actually essential. It lets air, water, and nutrients finally get down to the compacted grass roots.
and that drastically improves the health of the lawn.
And the crucial detail from a business model perspective is that this is not a constant service. It's usually just once or maybe twice a year, spring and fall.
Right. So our mission today is to figure out why this very specific niche can boast profit margins. We've looked at sources from 4 key regions, the US, Canada, the UK, and the broader EU, to really understand the global drivers and figure out how something so physically demanding can have the financial efficiency of like a software company.
So let's start with that market context, because this isn't just basic lawn mowing. That's a super competitive space.
Totally different.
Aeration exists as this premium high-value add-on.
Precisely. This niche just benefits from huge structural advantages. First, you've got high repeat demand. Once a customer sees the benefit, they're pretty much locked in for annual maintenance.
Okay.
Second, the material costs are, they're laughably low. We're talking about fuel and maybe some grass seed, not expensive raw materials.
And the third?
The third, and this is a huge global trend, is this move toward natural lawn health methods over just dumping chemicals on everything.
Okay, let's unpack that global appeal. Because if it's working on 3 continents, it has to be serving different needs, right? Climatic, cultural.
It really is a study in contrasts. If you look at the USA and Canada, the demand is just. It's overwhelmingly driven by what our sources call the prestige market. The perfect green lawn. It's a status symbol, a huge piece of your home's curb appeal and its property value. So people will pay a premium for that. You could almost call it a tax on vanity.
That feels very different from the European drivers, which seem more about,
Yeah.
well, necessity or even regulation.
Exactly. You hop across the Atlantic to the UK, and the climate is damp. So you have these unique issues like constant moss buildup, drainage problems.
Right.
Aeration directly addresses those core climate issues.
Right.
It becomes a maintenance necessity, not a luxury.
And then on the mainland EU, in places like Germany, France, the demand shifts again. I'm guessing regulation is the key there.
It absolutely is. This is all driven by the eco-lawn trend. As the EU brings in stricter environmental rules, banning or heavily restricting the strongest chemical fertilizers and pesticides,
You have to find another way.
mechanical aeration becomes the mandated solution. It's basically a compliance cost, a tax on regulation, you could say, that creates a guaranteed market for these operators.
So whether you're trying to impress your neighbors in a suburb in Ohio or you're trying to comply with environmental laws in Germany, aeration is the answer. And this is all happening within a massive sector.
Oh, massive. The U.S. lawn care market alone is over $100 billion a year.
Wow.
And the UK and EU market is another 20 to 30 billion on top of that. So it's this huge fertile ground for operators to carve out these really profitable niches.
Okay, let's stop talking about markets and start talking about money. Standard lawn care margins are pretty modest. We're talking 5 to 20% net profit industry-wide. How does a physically tough service like aeration jump past that 20% ceiling?
The low material cost is really the structural key, and you couple that with high efficiency. So a well-managed general landscaping company might hit, say, 15% net profit.
Okay.
But a specialized aeration business, one that's optimized for routing and just focuses on this one service, they can realistically achieve 30, even 40% net margins.
Okay, 40% that's incredible for a physical trade. But here's the aha moment in the sources that I found almost unbelievable.
This is the number that makes everyone do a double take.
Right.
For the highly efficient owner-operator, so the person who owns the machine and is doing all the labor.
Well, and doing the work.
Exactly. If they calculate their labor costs as their take-home pay instead of an operational expense,
It's just their salary.
The effective net margin can climb all the way to 60, 75, or even 80%.
Whoa, whoa, wait a minute. 75% net margin. That's higher than the average a software company, which has zero material cost and can scale infinitely. What are we missing? What's the massive hidden cost or risk here?
The hidden cost is that 75% margin is the owner's sweat equity.
Uh,
That margin is their highly profitable salary. The second they hire a crew to scale beyond what they can physically do themselves, that margin drops. It
Yeah.
drops right back into that 30 to 40% range.
because now you have management, insurance, third-party labor.
All of it.
Yeah.
It's a stellar owner-operator model, but it's not an infinite scale model.
That makes perfect sense. So it's a high-leverage job, not necessarily a high-leverage company. Let's ground this with a projection for a solo U.S. operator.
Okay, so let's assume one operator manages to do 500 aeration jobs in a season. That's achievable if they're focused on marketing. And let's say the average ticket price is about $150.
Right.
That gives you $75,000 in gross revenue.
Okay, so after all the true operating costs, fuel, maintenance, marketing, insurance, but before the owner pays themselves, what's left?
You're left with a net profit of around $30,000.
Which is a rock-solid 40% net margin. And you have to remember that 75 grand in revenue is generated over maybe 6 to 8 months. It's a powerful seasonal cash generator.
It really is.
Let's break down the unit economics for a standard residential lawn, let's say 5,000 square feet, to see where that efficiency is really coming from.
Yeah, the numbers are fascinating. The standard price for a lawn that size averages around $150. But the total direct cost per job, not counting the owner's time, is incredibly low, about $60.
Walk us through that $60. Where does it go?
Okay, so the physical costs are tiny, maybe $7 to $10 for fuel and transport, $5 for equipment wear and tear.
Okay.
The biggest non-physical cost is actually customer acquisition, which could be $15 to $20 if you're using online ads or printing flyers.
Right.
And the rest, that $25 to $35, is what you'd pay in basic wages if you hired someone for the, say, 45 to 60 minutes it takes to do the job.
So you take the $150 price, subtract that $60 max cost, you're left with $90 in gross profit.
It's 60% gross margin right off the bat.
And that explains the owner-operator's 75% number. They get that $30 labor cost plus the $90 gross profit.
Precisely. Now, this gross margin is strong everywhere, but regional factors really dictate how often you can run the machine and how much you can actually charge.
So let's look at that. How does seasonality change the strategy?
Well, take the USA first. Average price is $120 to $200. It's a huge, dense market, so you can get high job volume, tight routing.
Which fuels that $30,000 to $75,000 revenue stream.
Exactly. Now compare that to Canada.
Okay.
The pricing is similar, a bit higher in Canadian dollars, $130 to $220. But the key difference is the season. In a lot of the northern regions, your operational window is short and it is intense. May through October, basically.
So you have to make all your money in a 6-month burst.
A very aggressive 6-month burst.
And then in the UK, we mentioned the lawns are smaller.
They are, which brings the average ticket size down a bit, maybe 80 to 150 pounds. But the operational advantage is that the season is basically year-round. You just pause for heavy frost.
Which completely changes the cash flow. It smooths everything out.
Right, you don't have those crazy peaks and troughs that Canadian operators have to deal with.
In Western EU.
Prices there average 90 to 170 euros. The season is longer, like the UK, but the demand is really strongest in those densely populated countries with a lot of private homes.
Which again, it all comes back to rewarding efficient routing.
Always.
Okay, this is where it gets really interesting for me. The jump from a good 20% margin to an amazing 40%. It's not just about efficiency, it's about making sure that $90 gross profit expands the second you park the trailer. It's the lawn health bundle.
This is the profit multiplier. The secret to any service business is realizing that your highest cost isn't the labor on site. It's the cost of getting there. The fuel, the transport, the marketing.
All the overhead to just show up.
Right. So once you're on the property, every extra minute you spend providing more service is almost pure profit.
So what are the best, highest profit add-ons you can sell?
The first one, and the easiest, is overseeding. You've literally just poked thousands of perfect little holes in the ground for seed.
The prep work is done.
It's done. Adding the seed is minimal effort. You can add $80 to the price, but the seed itself might only cost you $20. That's a 3 times return on your cost, and $60 of extra profit.
For an extra, what, 10 minutes of work? That's a huge multiplier.
And it gets even better when you add bulk materials. Top dressing sow, spreading compost or specialized soil over the lawn after you aerate, that's a high-value service.
I bet.
You can charge an extra $150 for that. Your material cost is around $40. That's $110 in extra profit.
Wow.
Then you have these low-cost, knowledge-based services like soil testing. The test kit might cost you $5, but you charge $40 for the service. $35 in pure margin.
I'm seeing the math now. A $150 aeration visit is now a $400 lawn health bundle visit with maybe 30 more minutes of on-site time. That's margin expansion you just don't see in physical services.
And if you translate that into a high-volume month, the figures are impressive. In a peak month, a single crew that's focused on these bundles doing 5 or 6 jobs a day.
So about 110 jobs a month.
Right. They can hit $40,000 in total revenue if they're good at upselling. But even on the low end, just the 150 ticket average, 110 jobs, is still $16,500 in revenue.
And running at that 60% gross margin we talked about, that single machine generates roughly $9,900 in net monthly profit. That is incredible cash flow from a seasonal piece of equipment.
Yeah. It certainly makes that initial investment decision a lot easier to justify.
Speaking of investment, if someone's listening to this and thinking about starting, what are the barriers to entry? If the margins are this high, why isn't the market just flooded? What does it cost to get going?
The low entry cost is actually part of the appeal. Your startup costs are generally under $5,000 to $10,000.
That's it.
That's it. I mean, compare that to starting a plumbing or an HVAC business. It's extremely low capital expenditure.
What's the main purchase? The aerator itself, I assume.
Yes. You can find a solid walk-behind core machine, the workhorse, for $2,000 to $4,000 used. The heavy-duty commercial stand-on ones,
The ones that save your back.
and increase efficiency dramatically, yeah, those can run up to $12,000 or more. And you just need a reliable vehicle and a trailer, which you can often get used for another $3,000. The physicality is the natural gatekeeper that keeps these margins high. If you can handle the labor, the numbers point to a very rapid return.
How rapid?
Our sources show the equipment investment can often be recovered in the first 2 to 3 months of operation, or, 250 to 500 jobs, depending on the machine. That kind of ROI is rare.
Okay, but let's address the risks. It sounds great, but it can't be all upside. What are the main operational headaches?
Well, the first challenge is that seasonality we discussed.
Yeah.
If you don't master the bundling and the upselling, you are just left with spring and fall work, and your income becomes really volatile.
Right.
The only real way to mitigate that is to get year-round contracts offering those other services like fertilization and pest control.
And then there's just the weather. You can't aerate frozen ground, but if it's too dry, the machine just bounces off the dirt like it's concrete.
Exactly. Weather dependency is a constant factor. Rain causes delays, but the most critical catastrophic risk is operational error, specifically hitting underground utility.
You're literally ramming metal spikes into the earth. What's the worst that could happen?
Hitting a sprinkler head is annoying and it's costly to fix, but hitting a buried fiber optic cable or critical utility line, that's catastrophic.
A business-ending mistake.
Absolutely. It's a critical insurability risk that requires you to be absolutely religious about call before you dig protocols.
Yeah.
The fines and replacement costs for knocking out critical infrastructure could wipe out several seasons' worth of profit in an instant. This is why liability insurance is completely non-negotiable.
So wrapping this deep dive up, we've looked at the global need, the astounding margin potential, and the path to scaling that profitability through smart upselling.
The bottom line really is that this model is incredibly robust. Lawn aeration is a high cash flow local service business, and it's described as one of the best recession-resistant outdoor services in both the U.S. and EU markets.
Because lawn health is just essential for property value and in some places, compliance.
Exactly.
So the key takeaways for you, our listener, are you're looking at startup costs that can be under $10,000. The solo operator revenue potential is substantial, $25,000 to over $75,000 a season. And the potential to hit 30+% net margins is very realistic.
And that margin is achieved by focusing ruthlessly on repeat business. The sources cite a 70% retention rate and leveraging that profit multiplier, bundling high-margin add-ons to maximize every single minute you're on site.
Which brings us to our final provocative thought. Given that the core profitability really relies so heavily on maximizing that average ticket once you're already there and minimizing travel time, What specific market density makes the difference between hitting a 10% net margin and achieving that aspirational 40%?
Right. If efficiency is everything, how much does geography dictate your success? Is it better to operate in a high-density suburb where you can literally walk the aerator from one job to the next, killing your fuel and transit time?
Or is the higher ticket price you might get in spread out rural areas enough to offset all that lost time driving between jobs?
The density of your customer base might just be the ultimate silent profit lever. Something to think about as you contemplate the financial potential hidden right there, just beneath your feet.